Welcome to the AICPA Town Hall Series, your resource for the latest news and updates on pressing issues facing the accounting profession.
Good afternoon and welcome to the AICPA Town Hall. I'm Eric Auskerson, one of your hosts for today. And weeks like this are what the Town Hall is all about. We've got a huge infrastructure bill that was just signed into law. We've got the reconciliation bill making its way to a vote in the House, and other breaking news that we'll be getting into. And the Town Hall is all about us, interpreting this timely information and working with the firms and finance professionals and companies on building strategies and capabilities for firm success. This really is our power hour together. So here's today's agenda. We're going to kick things off with Barry Melanson, and we're going to talk about what's going on in DC, and we'll have some broader profession-wide comments. We're going to talk about the sunsetting of ERC, a quick update on the state of PPP forgiveness, and then with the current chair, Bill Paroli of the AICPA, we're going to get into some pricing and client strategies as you move into tax season. And we'll close with our open forum. So here's the lineup for today. I want to bring Barry Melanson up, who you all know, to start things off, and we'll be introducing the others as they join. So Barry, welcome. It's great to have you back. Last time you were with us was in October when we were actually discussing the vote by the House on the infrastructure bill. So we'll be getting into that here in the news. I mean, is an in-depth article on how Sinema is really thinking about this legislative process, and there's just so much going on. And what we're going to start things off with, actually, before we get into the infrastructure bill that was just signed into law, is to talk a little bit about where things stand with the reconciliation bill. And Barry, we'll look for you to give us some new predictions on how these things will unfold.
I can't believe you're not giving me a hard time about our prediction last time when we were live, and I said that the House was going to pass the infrastructure bill that night. I thought you were going to sort of give me a hard time on that. The reality was it didn't pass till Saturday, so we were on a Thursday night. But in Washington time, that's all one big blurry day. So Thursday to Saturday is just one big blurry day. So now we're at the reconciliation bill, and that is where the tax provisions, the primary tax provisions, will be, and that is, frankly, it's set up so that it can pass with a 50 vote, 51 with the vice president margin in the Senate. So this is a simple majority piece of legislation. A lot of things have been through the reconciliation process in the past. And this one is waiting. It failed. The speaker failed to get the votes a couple of weeks ago, primarily because she lost some Democrats on it. A handful of Democrats who said they were not going to vote on it until there was a score by the Congressional Budget Office. And we're expecting that score anytime now, literally in the next hour or so, potentially while we're on this town hall. And we're expecting that score to be, although it's probably going to be deemed a preliminary score, it will be about what the White House has been claiming it will be. And that will give, I think, momentum to the speaker to move this bill forward on the House floor, probably tonight. We've got Thanksgiving week looming next week. Probably tonight. It will be sufficient to sort of flip those Democrats back. There might be one Democrat that might not vote for it, but that won't be enough to stop the bill from passage, and then it'll go on to the Senate.
Well, Barry, when you look at that, it getting passed potentially tonight over the next couple of days, and then going to the Senate, what's the likelihood of it staying in its current form, and how many changes do we expect as the Senate takes this up?
So there's almost no likelihood that it stays in its current form. There will be, and certainly won't probably move very quickly through the Senate. There are a lot of things that could be pulled out by the Senate parliamentarian under what's called the Byrd Rule, which basically says that all all items in a reconciliation bill has to have financial aspects, revenue expense type aspects to it. And there are certainly some social issues that are that you can word certain ways to say that are, financially oriented, but not all of them have been worded or likely will have been worded that way. That will probably not get through the Senate process. There's an expansion of Medicare. There's some climate aspects in the bills. Most of those will probably survive. There's the issue with the SALT tax, the state and local tax deduction that falls into it. That probably will change or get pulled out in the Senate. So those are some of the major issues that are really in play with that process, and there's others, but that will cause the bill to have changed. We do think ultimately, but more likely around Christmas time, right before Christmas. It's not probably something that's going to get through before Thanksgiving or very, very quickly, that the Senate will find a way to pass that. We'll get senators, particularly Sinema and Manchin, on board. A big controversial point is the minimum tax for corporations. And that, that could get pulled out. It's very complicated. If it gets pulled out, it's going to have a fiscal ramification to it. So something else will have to go back in, like potentially an increase in the corporate tax rate, which is not in there now. The individual tax rates, except at the highest level of income, is not in there. The capital gains rates are not in there. So that could go back in to offset taking out the minimum tax. And then ultimately those trade-offs will get it through the Senate, and then it'll have to go back to the House. And some of the things that get pulled out will be difficult for some of the progressives in the House to support, but they have been on record making sure that got through the House. And even though it won't survive into final legislation, the general consensus, I think, is that Speaker Pelosi holds everyone together and gets it through sometimes before the end of the year, as I said, probably before Christmas.
Well, it's going to be a busy time, and you're seeing a step up of lobbying activities are getting more and more intense. I mean, we've been talking about this on the town halls since August, when we kind of did that little civics lesson of how this reconciliation bill works. When you look at this bill, Barry, and we look back at the most recent big tax change in 2017 with the Trump Tax Act. How do you see this from a magnitude standpoint? This change versus that change, I guess now, that's 4 years ago.
Yeah, and from what was talked about to what it will ultimately be in the final passage. And so if we think about it in the final passage, I think the complexity, the magnitude of the bill doesn't rise to 2017. I mean, it's just you think about the tax magnitude, our members implementing, dealing with, learning, all of those aspects, it probably doesn't even rise to 50% as it relates to the magnitude of the tax ramifications. Certainly, if you're affected by one, you may think it's 100% as bad, or effective, or whatever you want to call it. But if you take it as a whole, I think it's scaled down from its ramifications. And clearly, for instance, the most complicated piece might be this minimum tax for corporations, which is going to would create a lot of complexity, some winners and some losers based on industries, pressures on GAAP reporting. It could get very, very dicey. If that comes out and instead you get a few percentage point increase in the corporate tax rate, tax rates obviously are a lot easier to deal with, and probably if its passage is around the time that we think it will be, it'll probably be rate increases that will begin, January 1. There won't even be sort of an allocation process in the 2021 year. So that I just think the complexity level comes down.
It comes down, and you look at the timing. If you look back, I mean, that Tax Act passed the House on November 16th, 2017. So the timing is very similar. Then that went into law December 22nd. So it's different times, but seeing in some ways a potential for a similar schedule. This passing right before the end of year holidays.
Yeah, and we've talked about that. It's the human condition. People put off to the last minute. Well, it's also a congressional condition, right? And deals get struck. People want to go home. in the Senate to pass a bill, there's something called like this, this magnitude. There's something called a vote-a-rama where they vote on just tons of amendments, and the Senate rules, take to the floor all of those amendments, and they just sit there and they vote and vote, and most of them extend all through the night. So, when do you do that? When do you have enough people there to get the votes? The Senate's 50-50. You can't, if you're the Democrats, if you're Senator Schumer, you can't have anyone missing. And so that's a bit of a complexity point as well. So it's not unusual that these are the ways the dates fall out, and I think your 2017 comparison proves it.
Well, thanks, Barry. What we're going to do now is let's move into the discussion around the bill, the infrastructure bill that has been signed into law. And what this chart highlights are the major tax provisions that were in the infrastructure bill. So some broad comments to kick off this review.
Yeah, there's a lot of noise in the system on the cryptocurrency asset transfer issue that's out there. There's some technical corrections in the disaster relief, the disaster extensions and relief provisions. And there's some other problems with that we'll talk about in a bit, but not related to this bill, but in the disaster area. I think the big one is the ERC, terminating the ERC at September 30th. I think that's going to create some. We'll have, I know Lisa coming up in a minute, but it's going to create some real complexity in the system and some unfairness. I think it's going to be a real problem for some small businesses, the way that's going to play out. And it just exacerbates it's going to exacerbate the whole backlog service level issue at the IRS, but also produce, I think, some probably unintended consequences if they don't waive the penalties. And it could be really a big hurt issue from a cash flow perspective for small businesses.
Well, why don't we bring Lisa up and let's dig in a little bit more to the ERC sunsetting early and how we're managing that. And Lisa, I know we've been issuing letters related to this. So why don't you give us kind of an overview on some of these additional details?
Yeah, thank you, Eric. So as we've been talking about, the infrastructure plan did sunset early, the ERC. The American Rescue Plan Act had extended it till 12/31/21, and then now we've had it sunset 9/30/21 for all but recovery startup businesses. So what's a recovery startup business? It's a business that was started on or after February 15 of 2020. Average gross receipts of $1 million or less, but the ERC for these startup businesses is capped at $50,000. So there are some businesses still eligible for ERC into the fourth quarter, but we know that a lot of businesses were counting on ERC fourth quarter that don't fall into this category. So as Barry mentioned, I'm hearing from small businesses who withheld ERC from their payroll tax deposits, and now they're worried. Are they going to get penalty notices? What's the repayment schedule going to look like? And how is this all going to clear out if they had filed an amended 941X, which you have to file on paper, and that's stuck in the backlog? So I think Barry's right. It's going to create some confusion. And that's what our advocacy team has been working on, is urging Congress to get with Treasury and IRS to address this now before notices start going out, and pushing for these guidelines.
Yeah, we're pushing already for advocates in this on the congressional side to be very direct with the IRS and saying they have to address this. Lisa's 100% correct. I mean, here's the worst case scenario. You've filed 941Xs. They're sitting in the system. Who knows when they're coming out of the system? They're probably 7 or 8 months of lag time that's in those right now. So you haven't gotten the refund that's tied to the 941X. Now you've reduced the deposits in October because of the retroactivity of this provision to September 30th. and all of a sudden you're going to have to pay that back. And as Lisa said, it's not only how you pay it back, but there's the penalty aspects to it. So the IRS owes you money, you owe the IRS money, they're going to assess the penalties, then you're going to respond to that penalty notice, and that's going to get put into the backlog process and never get handled or not timely handled. And, you know, for the members who are in public practice doing this tax work, their clients are going to just be ultra frustrated on top of the cash flow issue. And it's, you know, for the notion essentially of a, 6 weeks or so retroactivity, it's going to just be a problem. And the smaller the business, the more of a cash flow problem that the business has, the bigger the issue. And so, we are all over this issue, and it is sort of a prime example of unfairness in the way that the system is backlogged today, and disproportionately to probably the people who need it the most.
Right. And Barry, we're getting a lot of, it's a live show. We're getting a lot of questions coming in. So I'm actually going to grab one right now and make a comment. One thing that we're hearing from some of the town hall attendees, we also heard from one of our partners, Paychex, that due to some of us stating that there was uncertainty here, there's a number of firms and their clients held off on filing, taking advantage of ERC for October. The question that just came in that I want to ask you, Lisa, is just, okay, so you haven't filed for ERC yet. You can still file for ERC, for periods prior to September 30th.
Correct. Yeah.
Yeah, it's not a filing deadline. It's a eligible wage deadline.
Right.
Absolutely. So it's always good to give, I think most understand it, but there was a couple of questions coming in on that. So broadly, as we look at the infrastructure bill, Barry, not a lot. I mean, the ERC was one of the big elements. We knew that this was most likely going to happen. And now the question is there any chance in the reconciliation bill for them to change this decision and fund it? I think it's been scored around $8 billion and put this back in.
So there's going to be lobbying for that, and there is lobbying for that. That organizations that are in industries that are particularly impacted, we see no chance that that's going back in. If you go back to what I just described in the reconciliation bill, likely to be passed, let's say tonight in the House, and then this sort of difficult process of amending it in the Senate. We just don't see that that's going to happen. So. And then I think the battle really is, and I think these groups that are lobbying for trying to get it back in are going to switch to be very much on the side of what we are going to be articulating, which is a relief on the actual implementation of the retroactivity. And Eric, I would say one other thing on the sunset that the infrastructure bill that doesn't have anything to do with taxes, but I just want to make this point, and we can cover it at a future town hall because it's not an immediate issue. But we've been talking about the ramifications of entities subject to Single Audit Act, and we've been using the number 7,500. That number is going to go up very high, given the amount of monies that are going to flow from the infrastructure bill to local activities. By the very nature, infrastructure is a physical local activity, and we're doing some preliminary, we got more work to do on this, but we think that notion of and we're working with OMB and the GAO, et cetera, on focusing on this, because that problem, if you want to call it that, it's an opportunity, but it's also a risk on the quality side, is going to go up.
Well, Barry, we're going to move into a more detailed discussion on PPP, but before we leave this section, I mean, if you think about 2021, you think about, remember in the spring we were talking about the huge economic growth, and some of the forecasts being above 7%. Then we had the resurgence in the COVID and more shutdowns, and now we've got inflation, and then you've got this tax bill happening. So it's going to some interesting discussions with clients as you lead into this tax season. Any broad comments for the audience here as they start getting ready for tax season and looking at mean, it's a very complex world that we're living in. Just doing that quick review.
Absolutely, and it's tax plus is the way I would answer it. I'd come back to my age-old point about trusted advisor. Look, I think we've talked about building up our skills in the supply chain side, which is still a problem out there, right? So building up our skills in the supply chain side. Now it's also really getting the attention and being a trusted advisor to the client on, how do I handle payroll or people, which is also a problem inside the profession, but how do my clients handle people, the salary ramifications, the business model ramifications, which includes the pricing, what's happening. Obviously, it's a very competitive landscape. And then also depending on the industry, what opportunities there might be from the infrastructure bill that you want to seize. So, I mean, you could build a pretty, bullet pointed oriented agenda to sit down over coffee with your entrepreneurial client. And there's a lot to be talking about. Hey, what about the ramifications of these 15 things to your particular business in your particular industry?
Well, Barry, great. We look forward to having you join us with Bill Paroli to kind of talk a little bit more about some of these firm strategies towards the end of today's town hall. So thanks. So with that, we'll now move in to some of the technical updates. I know we've also got some late breaking news, some information that just broke.
Yeah, late breaking news, and I apologize for looking at my phone, but it's really breaking news. So we got some IRS guidance released just a little while ago, within the hour, around the Paycheck Protection Program, so our favorite acronym of PPP. And they've provided guidance on partnership allocations and basis. I know that was a huge issue for so many of you as you were holding off on filing your partnership returns because you didn't know when and how to allocate PPP. So a couple of high-level bullet points. They've released RevProc 2021-48, which addresses the timing of taking the expenses on the return and how that ties into tax-exempt income, because PPP income isn't taxed. So you can treat that as eligible expenses are paid or incurred when an application for PPP loan forgiveness is filed or when PPP loan forgiveness is granted. So they're giving us some flexibility there. We've got RevProc 2021-49, which provides guidance for partnerships and consolidated returns on the basis issues. And then RevProc 2021-50, which is allowing amended returns for these partnership partnership returns that were filed. That is, again, our team's going to need some time to look into that and synthesize it. We'll report back out to you once we've had a chance to dig into it. But I did just want to let you know that some of that guidance that we've been waiting for has just been released. So stay tuned. Journal of Accountancy or following us on social media is going to be your best way to keep up with it once we've got that analysis out there.
Well, Lisa, I think it was allowed for you to read from a phone with that all the technical details and that just literally coming out as we started this town hall. So here's the latest stats on PPP forgiveness. You can see 8.6 million have applications for forgiveness, and 8.4 million have now been forgiven. So that's a high percentage. 75% of all of the PPP loans submitted. But what we can tell you, and I think many of you know this, is that the firms, some of the applications that the firms are supporting for their clients are still in process, and that the number we do run a program. There was over 1,000 firms that were active in doing PPP loans, and about 35% of their loans have actually been submitted and forgiven. So it's a little bit lower. We expect that to pick up as this year finishes off, but there was good reason just to wait and make sure you got the ERC and PPP interplay right.
Yeah, and you were busy with tax season. So, we've got 2.8 million applications that haven't yet been submitted. And, we think we'll see an uptick in that between now and the end of the year as borrowers look to get all of this cleaned up for their 12/31 financials. But, the good news is if we flip to the next side, the forgiveness trends are still very strong. This is for both 2020 and 2021 loans. And if you look at those categories by loan size, most of them are at over 99% of the requested amount is being forgiven. So again, positive trends there. And we do expect to see an increase in uptick in the number of applications being submitted.
And what I also continue to hear, Lisa, is that there's a positive experience occurring with the clients with this forgiveness process. There was a lot of anxiety in getting these applications in and worrying if the money was going to run out. You don't have those types of pressures now, and the clients really are greatly appreciating getting these PPP loans forgiven. It's a great end to this program. So with that, Lisa, is there anything else that we want to cover on PPP before we move into this next section, talking about business model and some firm strategies going in the tax section?
Yeah, I'm ready to get into the fun stuff. Let's talk about business models.
All right. So with that, let's bring up Bill Paroli, the chair of the AICPA, partner at DeSanto Priest, and former chair of PCPS, who's been connected to the profession for professional leadership for many, many years. Bill, it's great to have you here with us today.
Thanks, Eric. Hi, Lisa. It's great to be here.
And we can bring Carl Peterson up as well, who leads the small firm section at the AICPA. So with that, let's kick this off. We're going to talk about some business model strategies, Bill, and get into some details around client management, client strategies, and pricing strategies. But before we do this, I know this is a slide that you've been using as you travel around the country. You talk to firms, you hear what's working for them, and these are some of the key attributes that you speak to. So love you to take the town hall audience through this slide.
Sure, Eric. From my days on the MAP committee, PCPS executive committee, I've had the opportunity to work with firms all over the country, and these common themes just kept coming out from the best firms that I talked to, and they're right there, and it leads to like strong leadership. I'm going to point out strong partner unity and highly accountable as being a big part of highly profitable firms. Specialty and niches. We found that firms that go deep on either an industry or a service line tend to be the most profitable. Repetition equals efficiency, and efficiency equals profit. But really, what it is about everybody rowing in the same direction, having a future vision for their firm about who they want to represent, who they are, and moving forward on that, and continually evaluating it, which is, I think, where we are right now. We've just closed the books on 10/15, which felt like closing 2 tax seasons at once for most practitioners. And we're coming into the next year, and now's the time. Now we've got to get back to strategy. And I'm laughing a little bit because I'm listening to the incredible complexity that we're dealing with and have been dealing with for 18 months. And I know we're going to talk about fees and have a conversation about that. But it seems to me that this time we have to be capturing our value, right? That value is that trusted advisor. And I think, firms need to do that evaluation right now before, next year starts for them.
Well, Bill, when over the past 18 months, as we've been leading these town halls, we're always talking about, okay, here's the latest business relief bill or amendment, and now we're talking about some major tax legislation. But what you've outlined here is so important, related to kind of really managing and handling all of these things that are thrown at you, that you have to provide guidance to your clients on. So it's like, how do you do that? And Carl, before maybe just a quick question to you before we get into the pricing and client expectations. You're hearing this from the small firms on at times how overwhelmed they are. But when you listen to Bill here, and we've talked about this previously, to be very intentional about what you're doing around leadership or what you're doing around your different practice areas and practice management capabilities. So any broad comments from you on what Bill just said?
I would add and just point out on the slide, there's two points here that I think are very important in today's firm, and that is empowering management team and transparency. I think if you want to retain your staff, you have to do that. All these components on here are very, very important, but in retaining staff, they are looking for transparency from above, and they want to be empowered. And I think you have those two things, you're going to strengthen your retention of your staff base.
Well, let's get into some, practical tips. So that's what we like to do in the town hall, is some really good takeaways on actionable things that you can do to advance your strategies and your capabilities. So we've got a couple of topics here. Bill, I'll have you, kick us off around a topic that you're very passionate on: client acceptance and how do you, manage those A, B, and C clients, and what are the right strategies related to that?
Yeah, and as Barry alluded to, we have pressure in the system on our people, right? We're having pipeline issues that'll affect us coming down the road, but we're also having capacity issues right now to handle the incredible complexity that we're facing every single day. And we can't just manufacture more people. We're in a talent war with not only between ourselves but outside influences. Private equity firms, investment banking, they're all looking for our highly trained people. So one of the things we can look at is, what is it that we want to do inside of our firm? What do we do best? Okay. Who do we do it for? And that's that client selection model that we're going to talk about. And then how do we do it? That's employing that, the technology strategies that you've been talking about for years, Eric, at CPA.com, and using that technology as a way to build capacity, right? There's a lot of ways to build capacity other than just putting people on top of an existing structure, because sometimes just adding more people doesn't work because the underlying business model needs to be changed. So that's kind of what we're talking about here, and really kind of pruning the tree. I'm a firm believer that no one should have bad clients, right? Bad clients shouldn't even exist in our firm. That's not what we're talking about. What we're talking about is, firms getting focused on who they can, adequately service going forward and give that good quality service in an extremely complex world. So just for some examples, in my firm, we went through an exercise in the last couple of years to, kind of dramatically reduce the number of standalone tax returns that we did, because we've been so busy with our corporate clients and their tax returns that we didn't have time, and we weren't giving those folks the service that they really needed. So we went through, these are all good clients, but we went through and we said, we have to change our model in order to be able to service our clients better.
So let's just talk a little bit more about that. So, I mean, so you looked at some specific categories, just standalone 1040s, but how did you determine, which other clients to break up with? How do you, how do you identify that list? And then, and Lisa's going to be sharing some of the PCPS tools. How do you go about those discussions?
Yeah, I mean, we have those tools, but I think that this is at a little higher level. This is at a strategy level. One of the things that we see that causes a lot of problems inside firms, especially on issues of quality, is if they're doing what I'll call onesies and twosies, right? They're doing one of this. They might have one audit of a nonprofit, and that's really causing problems with quality, and they should really be out of that. They shouldn't be doing that. So it's lines of service that we look at, and we made a decision a couple of years ago to no longer be in the HUD audit business. It was just it was pulling too much from our staff, and we needed those resources to deal with PPP and all the complexity that we had there. So, we do have some tools, try to figure out who's an A, who's a B, who's a C, who's a D, and we call F clients friends and family. We can't help you with those, right? You're stuck with those. But, going through that evaluation on your clients, and again, they're not bad clients. It's just they no longer fit with your current model and where you want you to take your firm in the future.
So, Bill, and if you want to do that, what's the bet? When's the right time? Are we in a? I mean, one reason why we're doing this in this town hall is we think the time is good right now. If you're going to do this to do this before end of year.
Yes, absolutely. This is you have to be fair to these clients. They've done nothing wrong, right? They're just no longer part of your model, your business model, and we have to give them time. And honestly, when we go through this process, we give them recommendations of other practitioners that we really like in our area. And, clients are precious, referrals are precious, and we can't just, dismiss them and leave them to their own devices. We want to help them transition them onto a service provider that's a better fit. And that's really what it's all about. And, what do we always say, Lisa? It's not you, it's me.
Exactly. Right? It's not you, it's me.
Meeting. And that's really what it is. It's about your firm going in a direction that doesn't include some clients that you've serviced in the past. And, it doesn't matter how long you service them. Everybody's loyal, but you'll never move in the direction strategically you want to go if you keep clients that don't fit.
So, Bill,
Eric, if I could add on to that, the timing is great to start that process now, because especially small firms, you're already looking at tax season coming up. You're thinking about the client base. You're thinking about how I'm going to make it through it, and looking at the clients that you should be serving and the ones that fit your business model and the type of firm you want to be. You have clients that you shouldn't be working on, and it isn't just the clients that may not rate highly. You may have some very profitable clients, like Bill said, that just aren't the right fit move forward. But if you do it now, they have time to get some year-end planning done if they have to have it. But they also have plenty of time then before their tax returns are really due, and before they get a chance to work with that new firm and get an idea of who they are and provide that data that they need. So now is a great time to do it.
Yeah.
Hey, bunch of questions coming in here, Bill.
Yeah, I'll bet.
All right, so just what's the best way to do this? Face-to-face, letter, phone, email, text?
Right. I like to, face-to-face is a little bit difficult these days. But I like to talk to the client personally, let them know what's going on, why we're making this decision. And again, it's not them, it's the firm moving in a different direction. And I've been through this, as Carl knows, I was in a small firm for almost 30 years, 6 people, and I merged up into a much larger firm. At that point in time, I had to leave some clients behind. And these were clients that helped us establish our firm. So it wasn't that it was, it wasn't an easy thing to do. But certainly I like to do, the ones that are going to be sensitive to it. I like to do those in person, but it's perfectly acceptable to do it in a letter format, especially with those standalone 1040s. We wrote them all a very heartfelt letter, told them exactly why we were doing it. And again, attached to that letter were a list of CPA firms that we like and we trusted to handle their affairs. And you know what? They call us up and they thank us. They say, you're going to get better attention at this firm than you're going to get in our firm. And they really appreciate that we're taking them to heart, and we're not just leaving them out in the cold.
So one more question, and we can move into at least we'll move into the pricing. What if you don't have some firm to refer them to, and say if they're a D client, and that's another reason why you don't have a place to refer them to. Well, remember, D clients are not necessarily bad. Those are the ones we need to improve and work on. They're keepers, but they need some help. But the really bad clients, we don't refer those to anyone. Mm-hmm. If Bill Reed were here, he would say refer them to the person you don't like in the profession, right? And let them torture them. But if you don't have anybody to refer them to, you just can simply tell them that. But I think most firms have
people that they know in the community, in the marketplace, that are friendly CPAs that you can find someplace to put them.
Yeah, Eric, there's also one other resource. I think we've run into that same situation, and you don't really have anybody that you want to refer them to. Typically, most of the state societies for CPAs have a referral program in place where they'll refer 3 different firms out. So I'd refer into the state society if I needed to.
So Bill, I got a question for you. Can I make a D client a B client just by doubling their fee? Is it just about the money?
So no, I don't believe that at all. Okay, because if you have a D client, they typically have some issues, right? And if you're going to go to them and say, hey, look, you're really difficult to deal with, I'm going to double your fee, I think you've just empowered them to be as dysfunctional as they were before, only more so, because they're paying you more. So in my book, I want to fix what's wrong with them. And I've had that before. And I've said, look, I think you can be a long-term client of the firm. These are the specific things you need to do to stay in our firm. Okay, you need to hire an internal bookkeeper. You need to upgrade your software. You need to bring your work in more timely. If you can't do that, then we can no longer work together. And then you've made it about them. It's their decision now whether they want to work within your parameters. But I'm not a big fan of just trying to price people out of the market because I think that word gets around in the community.
Well, that's a good segue. I mean, as Bill, you said, and with all of these things, it's not a one size fits all. There could be some situation where you realize you need to increase prices, and that's if that's the sole issue with that client, that could fix it. But let's move into just pricing strategies. We've been talking. We had Ron Baker on earlier this year. We talked about subscription billing and the importance of that, and value billing moving to subscription billing. And I think we all see the valuations of the SaaS companies, which are based on subscription billing. There's a lot of value. There's a lot of value in that business model. And we do know firms that are moving to subscription billing. So that's just one element of the pricing strategy. Another is at times, prices do need to be raised. So why don't you kick us off here, and then we'll get Lisa and Carl will continue to add comments.
Yeah, there's a lot of alternate types of strategies that you just mentioned. A lot of people are using fixed pricing. But the reality is that about 75% of the revenue in our profession is still earned by the hour. Better or worse, that's a conversation for another day on timesheets and hourly keeping. So if you're going to be in that model, we just want to make sure you're capturing your value, right? Don't give away your value. Don't give away your efficiency. We're making huge investments in technology. We have to make huge investments in education. We've been running, training sessions for the last week in our firm. Everybody's down because we're trying to learn everything that's coming. And that's part of your pricing structure, right? You need to keep your rates competitive, but fair. And, right now we know we have clients that maybe not in the best economic situation. So you have to have that in the back of your mind. And, there's an old saying that clients can afford us the least when they need us the most, right? They're in that bad situation. We've seen that over the last 18 months. And then you have to make a decision as a firm to support those clients going forward. I'm not an advocate of cutting somebody loose if they're in economic distress. So there's some loyalty that goes both ways. But really, I want you to, we can look at it, and you can have multiple pricing structures. As you said, CAS is really perfectly built for that fixed pricing. Okay, but there are some other parts of a practice where hourly has to be used. It's it's either contractual or something like that.
Oh, Bill, one thing that we were all talking about is the talent issue, and then the cost of talent, and that goes into the pricing, obviously. So especially recruiting, new junior talent. So to get the right talent, you have to pay more. Then obviously you got to connect that with your pricing model.
Right. I mean, I think if you look around for the rest of your affairs, your business, your personal life, the cost of nothing is going down, right? So we have to, you have to keep pace. Clients are not expecting you to not, to not raise prices. They expect you to that you're making money doing what you're doing. So, as you said, Eric, we're making some tremendous investments now in talent, training, and technology. Are really chewing up a lot of our budgets, and all the stuff that we saved money on over the last 18 months on meals and entertainment and Christmas parties and all that, that's all starting to come back as well. So you need to take all of those into consideration and really just take a hard look and determine whether or not you're capturing your value for your firm so that you continue to have a sustainable firm. You have to build that firm for the future.
Carl, I mean, we're not calling this Carl's Corner. This is Bill's Corner here today. But Carl, how do you when you're out there with the small firm networking groups, how are they thinking through this?
Well, I'll tell you, the business models certainly are changing, and people are watching them. And we touched a little bit upon retention and recruitment. And I've got just in the last 2 weeks, I've had a firm tell me that for retention, they're going to do a 30% across the board pay increase for everybody on staff. And so the impact, I mean, we're all impacted by inflation. So that's going to have an upward pressure or a change in your business model and your pricing strategy. Another firm, small, and these are small firms, another small firm said in recruitment, they have now put out an ad for just a 3-year person, somebody with only 3 years of experience, and they're offering $100,000 base salary. I mean, can you imagine 3 years at 100,000? I mean, I don't think those numbers, we haven't seen those. And, but I think that's the world we're moving into.
Yeah, well, so we are seeing that. We're all seeing the marketplace. You see, with the bank, and I'm in New York today, and what the banks are offering, they're starting associates. So Lisa, why don't we get into some of the resources? I can tell you there's an active discussion. It's almost like some people are just giving us their thoughts on how they're managing clients and these different elements. And there are questions, Lisa, about is there sample termination letters and things like that that we can share. So I'll let you take this away.
Thank you. So within PCPS, we've made this resource available to everyone because it's such a valuable component of running your practice effectively. And it really is taking a look at who are the right fit clients. And this one's based on an existing client, but we also have one that you can search for on the site around accepting new clients. So not just taking everybody that walks in the door. We've all heard jokes about if they're breathing, I'll take them as a client. So being more deliberate and strategic about it. But from a client continuance standpoint, we've put together, based on feedback from practitioners like you, what some of the key considerations are in determining what's a good fit and what clients do we want to keep. This is a spreadsheet that you can download by using the hyperlink at the top of the slide. So that's our reminder for this week. Download the slides from the resources section of the Town Hall platform, and you'll get that link. You can edit this. It's a spreadsheet. So if your firm has decided there are different factors that you think are important in determining fit and whether or not you want to continue to work with them, then you've got this spreadsheet. This is it's about the numbers, right? So you go in and you subjectively look at some of the factors and come up with the total score, and then say this is one that we either need to talk to and bring it from a D to a B, or it's not salvageable and we need to have a different conversation. So if we have to have that different conversation, then we've got some resources on the next slide. And these are going to help you with the infamous "it's not you, it's me" conversation. So we talked about some resources that Aon and CNA, our liability insurance partners, had put together for us. So you've got that link again, because there's some really good tips on what to consider as you're thinking about these conversations. PCPS and tax section members can also access a checklist that will walk you through all of the steps around, making sure that you're managing the risk of ending a client relationship effectively. Great tips in that Aon piece as well, and then some sample termination letters in both of these resources for you. So Bill, I have a question for you. How do you figure out If you don't go through the spreadsheet and put numbers aside each of those categories, how do you figure out which clients you should probably move on to a different relationship?
I mean, I've been teaching the improving profitability class at Engage for years and years. And Carl, to your point on transparency, I actually teach a class on firm economics that we push out to every single person in our firm that teaches them the business of accounting. And you know, when I teach this class, I start off by saying, I'm not going to tell you anything you don't already know. You already know all of this. We're just trying to give you the courage to move yourself forward. And if you don't want to go through the spreadsheet, you probably have a pretty good idea. But if you're not sure who to ask, right, start with your staff. Go to the person that answers your telephone. Right, they're going to tell you a little bit more about your clients that you don't know. And then if you're really not sure, go home and ask your spouse. Right? Because you're carrying this weight home with you on these clients and you're talking about them, they're going to give you a pretty good indication of maybe some clients that should go that are adding a little bit too much stress to your life.
Well, I think this is a good segue to bring Barry back up, and we can drop the slides here. So I think, you know, what we're trying to do here in the town halls, I thought that was a great discussion about client management, thinking about business model items, and in this time of unbelievable opportunity, Barry. I mean, we some town halls, we get that feedback. We're saying, you know, we're going to be talking about client accounting services 2.0 and how this is such an incredible opportunity. And they're like, I've got more opportunities than I can handle. And what we just did for 20 minutes here was talked about how to, you know, some of the top attributes that Bill kicked us off with, and then some techniques to think about, you know, your service lines and your clients. So I know you think a lot about this in the discussions with firms. Why don't you offer some perspective on what you just heard this panelist group discuss?
Well, the panel did a great job, and every time Bill talks about asking your spouse, it puts a smile on my face because I've heard him say that 50 times, and every time I just always think about the ramifications of that and the conversation. It's solid advice, and I think Lisa and the tools and Carl really from a very, very small perspective. I'd have two observations. One, I think when Bill was talking about, you know, talking to a client and saying, you know, the only way we can continue to serve you is if you do X, you know, moving that D to that B. I do think there is a tie there to the business model aspect that can be effective, and finding, and not for all clients, but for a lot of clients, a win-win. So for instance, if you're going down the CAS process as a firm, or CAS 2.0 as we're focusing on where that's going next, it could well be that those D clients, in order to get them to B, it's only if they do other services with you and there is a benefit to them that you can portray to them, and we sort of change the whole relationship, the scope of the relationship. And I think that's a good one to keep involved. I would say that over the years, the thing that I hear mostly from very small practitioners in this space, and Carl may or may not back me up on this, I don't think we've had a recent conversation on this, is the fear factor. You know, when you're a very, very, very small firm and you have whatever is your top line revenue, any one client is a concern, and there's always the fear that in a downturn, will I have wanted to keep that client even though I was working with them at a different level or in a different way? I do think the environment that we're in right now, because of what you asked, Eric, about the incredible amount of opportunities, I would hope that people who have traditionally gone to the fear factor could take a step back and really think about those opportunities today. I don't think the opportunities collectively in the profession have ever been like they are today. And I've been at this for an awful long time. And so those that get hesitant because of fear, now's really a time maybe to step back and think about it differently. That would be my observations.
Yeah, I agree with you, Barry. Absolutely. In fact, that fear factor still runs rampant today. But those small firms, and probably other firms as well, but the small firms that actually do that, they find out that their anxiety level goes down, their income actually goes up because now they're able to work with the clients that are asking and wanting more services. And there's so much work out there, especially today, that you're going to fill that gap. So.
Yeah, we didn't talk about leverage, Barry, and I think that's the conversation you're having. The best clients in the firm are the ones that we can leverage with our additional service suite. But even if you're a solo practitioner, I would tell them that all the business they need already exists in their practice, right? All they need to do is create a little bit of bandwidth. And to Carl's point, they're busy servicing Ds while the As are begging for more work. So that hole will always fill. There'll always be another client. And again, it's about the courage to take that first step.
Yeah. But it is a point in time. This topic is timely. It is a point in time because of the environment we're in. Absolutely. And in most people's careers, there's never been a point in time like there is right now. And I just would encourage people to really focus on that.
Absolutely.
And Barry, on that, this was very intentional that we brought this topic here on November 18th as we're finishing off this year. And Bill Paroli, thank you for the leadership. You're out there. Bill's traveling. He's traveling around the country, meeting with firms, meeting with the states. So thanks for all you're doing. And we've got, Lisa, I know there's some tax questions that you've seen coming in that you want to address.
So a shout out to April, who's monitoring the questions on the back end. And I wanted to clarify that on some of the timing guidance that we got today, it's not just for partnerships, it's also S Corps. So again, sorry if I created confusion there, hot off the presses, but again, stay tuned, give us a chance to dig into that, and we'll get some analysis back out to you. But again, it's exciting to get that long awaited guidance.
So with that, everybody stay with us, and let's just bring the slides back up, and we're gonna cover some of the resources and some exciting things that are coming up related to the town hall. So you can watch any of the archives on AICPA TV, YouTube. We also have the podcast versions. Today we've got over 7,000 people attending, and every week we've got a couple thousand archive views of these town halls. So thank you for your engagement there. This is a huge opportunity. Client accounting services is one of the highest growth areas in the profession. We've been at it for a decade now, and we're going to be putting in place tools and capabilities to help firms really crack the code and deliver state-of-the-art practices. So you're going to hear a lot more about CAS 2.0 in December and going into 2022. So we try to leave you a summary of today's town hall and these closing slides. We also have our newsletter that we send out to you. So we covered a lot, but this boils down some of the key points for you. We are going to have a special edition of the town hall live from Digital CPA in Nashville. Everybody on this panel is going to be there, and we look forward to having you join us. Your calendar invite has that scheduled it's a Tuesday, so it's not a Thursday, it's a Tuesday. December 7th at 1:30 p.m. East Coast time. That one request we get sometimes from the West Coasters is not to do this over lunch hours, so we'll be doing this earlier in the day for you. Here's the next two town halls coming up. The one I just reviewed, that will be live on December 7th, and then we're going to really work on a year-end one, December 23rd. So Barry, I'll let you kind of close us off. We'll see. It'll be you'll be with us on both of those. Look forward to December 23rd, and if we have to, we always will do a special edition. So that's one thing. If something breaks and we think it's important, as we've done in the past, we will have a special edition. So Barry.
So look for the vote in the House tonight, but remember, technically tonight runs from now till about next Wednesday. That's the definition of tonight in Washington. So.
Thanks, everybody. Thanks for being with us, and we greatly appreciate all of your questions.
Thank you all.
Thank you for your participation. You can now subscribe to the AICPA Town Hall series on your favorite podcast platform, as well as watch archives on YouTube and AICPA TV. Tune in for live broadcasts Thursdays at 3 p.m. Eastern Time.